Okay, 2023 review, 2024 outlook. This is going to be exceptionally short because I don't think these are particularly valuable, particularly the outlook part of it. But I know people want to have some information. So this chart is put together by Bespoke. They are a wonderful investment research firm, and they just published it on their Twitter account. I don't need to recreate the wheel. When we look at this column for calendar year 2023, we can see returns for U.S.-based equity indexes. These top two segments here, these are broken down by size. So large companies, small companies, mid-sized companies. These are broken down by growth and value, so the style. There are currency returns, there are industry sector returns, and then over on the right is global, international. So individual country returns, regions, so this is developed international, Europe, Asia, Far East, Europe, Australasia, Far East. Emerging markets, kind of the others, the alternatives, commodities, that sort of stuff, and then bonds. So stocks went up. So just looking at the U.S., the S&P 500 returned, the S&P 500 ETF, SPY, that particular ETF returned 26%. If you're noticing that the NASDAQ 100 QQQ did double that, and you're thinking, man, that would have been a much better place to be than the S&P 500. Just for context, understand that since the market topped in January of 2022, the blue is the Qs, the NASDAQ, and the green is SPY. So the blue is this and the green is that. Over that time period, they're basically right on top of each other. The Qs, the NASDAQ has slightly outperformed, less than 1% than the S&P 500. But it still hasn't reached... it still hasn't gotten back to where it was at the beginning before we've had the most recent downturn. So the S&P 500 is super, super close to being back to where it started January of 2022, whereas the NASDAQ is a little bit further behind and has not fully caught up yet. And that just goes to show that, yes, even though the NASDAQ did double what the S&P 500 did in calendar year 2023, if you were invested longer than 2023, it's really not much better, if at all, because the NASDAQ had such a tremendous downturn as compared to the S&P. So if we look at this in calendar years, the NASDAQ has doubled the S&P this year, but it also did significantly worse in 2022. So if you've been invested for longer than a year, the S&P is just fine. And then, of course, so far in 2024, the S&P is beating the NASDAQ for the time being. But basically, across the board, stocks did well. This is the time where I, as the advisor, have to apologize for having you be diversified, and that is because the S&P 500 did the best. Large caps, large companies did better than small-size companies here. 16.07 is measured by the S&P Small Cap 600 Index. And mid-cap companies, mid-sized companies, is measured by the S&P Mid-Cap 400. So none of my clients just have pure S&P 500, U.S. large companies. We're diversified, and that diversification drug you down. Still good performance, but nonetheless, the best returns were here in the large cap space. Over the long term, mid-sized companies and small-sized companies are expected to have higher growth rates to correspond with their higher risk profiles. Let's see, developed international stocks as measured by EFA. Again, Europe, Australasia, and Far East Asia, up 18.4% in U.S. dollar terms. So didn't perform as well as U.S. large cap stocks, did a little bit better than U.S. mid and small cap stocks. And then emerging market stocks, which my clients for which I manage the money did not have exposure to this year. In 2023, we're up about 9%. And then bonds, I will keep saying this over and over again. Bonds are where the real story has been for the last 2 years. The U.S. aggregate bond index was up 5.65%. That was led by short-term treasuries as compared to intermediate and long-term treasuries. If you were to look at my 2022 review and 2023 outlook that's posted on the YouTube channel, you would see where I talked about a lot of people last year were suggesting that it would be smart to pile into 20-year treasuries because they had been so decimated in 2022. I'll just add that here. These long-term treasuries, as measured by TLT, were down 31% in 2022, and so people were saying we should really pile into these in 2023 because they should return better. It didn't come to fruition, and frankly, I'm glad that that we really avoided that kind of trade and didn't try and make a bet like that. I fundamentally don't believe that bonds are where we should be taking bets or risk to try and drive outsized returns. That comes from these equities where we expect to have major drawdowns every few years, and the reward is much larger long-term returns over time. I don't believe that's what we should be doing in the bond market. And so similar to last year, there's once again a large contingent of talking heads out there that think we should all be piling into long-term treasuries. And I just simply disagree, and we're not doing that here. That's that's 2023 review. Any questions, ask me. For 2024, I think the main thing that should be in focus is what is the Federal Reserve going to do with the Fed funds rate. So this is a fairly complex, not easy chart to decipher. What it's saying is across the top, we're looking at these meetings date, these meeting dates. The Federal Reserve Board meets on a regular basis. Here are the dates: January, March, May, June, July, September, November, and December of 2024. And they'll decide what the Fed funds interest rate should be. And right now, it is, they always target a range instead of an exact amount. And the range is 5.25% to 5.5%. So that's like the bare minimum interest rate out there in the market, which is why other interest rates are higher. They're all keyed off this, and this is generally the lowest interest rate in the market. And so that's where interest rates are right now. They're between 5.25% and 5.5%. 2 years ago, they were down at 0. And so the reason that we saw such a dramatic decline in stock and bond prices in 2022 is because these interest rates went up from 0 over all the way to where they are now, 5.25% to 5.5%. What you're seeing in the table below are the probabilities that where this interest rate will be over time. So at the January 31st meeting, the market is pricing in a 95% probability that interest rates will stay where they are. They will not move. They will not go up. They will not go down. It is pricing in a 4.7% probability that the Federal Reserve will lower interest rates by 1/4%. So instead of the range being 5.25% to 5.5%, the range will get dropped to 5% to 5.25%. And then it just goes on. Each row is the following meeting date. And you can invest in what are called Fed funds futures. This is how we determine what is the market pricing in. There's actually an investment contract, a futures contract to make these bets or run these hedges. And so what is happening is currently the market is pricing in a 69% probability that there will be one rate reduction by the March 20th meeting. And you can see with these blue cells where the largest weight is for each of these rate reductions. And what it means is by December 18th of 2024, we would expect 1, 2, 3, 4, 5, at least 5 rate reductions, maybe 6, maybe 7 rate decreases of 0.25%. So if we just said 6 rate reductions at 0.25%, that's 1.5% decline in interest rate. So we'd go from 5.25, 5.5, all the way down to around 4 or so. That is what is priced into the market at this point. I think this is the most important thing to watch. In my opinion, that is really aggressive, that is very rosy picture in terms of what is the Federal Reserve going to do with interest rates. My opinion is that as long as the U.S. economy doesn't enter a major recession, that the Federal Reserve is not going to feel a need to reduce interest rates in any meaningful way, because they still need to keep their eyes focused on inflation and make sure inflation doesn't come back to the degree that it did previously. And so the major risk, in my opinion, to the markets is that right now the markets are pricing in a really rosy picture, reduce interest rates, boost stock and bond values. Well, if that doesn't come to fruition and suddenly there are fewer interest rate hikes baked into market pricing, that could definitely be bad for bonds and potentially be bad for stocks. The other thing to think about is what would cause the Federal Reserve to need to reduce interest rates. Well, one thing would be a severe economic downturn, which usually is bad for stocks. So, I don't know what's going to happen. I don't know where the market is going. We've nearly reached back to all-time highs that we experienced back in January of 2022. We're almost back to where we were in terms of the S&P 500. There is what I believe to be a pretty rosy scenario baked into the market based on expectations for interest rates. And to me, the big risk is that we don't get this many interest rate cuts, and that will cause a repricing of both stocks and bonds. And if you want to know where I think the risk is, that's where I think it is. All right. Any questions, let me know. Happy to discuss it. Could talk about it for days, but just trying to keep it somewhat short here. Thanks.